Good afternoon, everyone, and thanks for joining us. My name is Janet Wright with the Farm Service Agency's Outreach Office, and I have with me today Adam Kantrovich from Clemson University and JC Hobbs from Oklahoma State University. And they're going to speak to us today about the One Big Beautiful Bill and some of the considerations you should consider during tax time. And they will be answering questions throughout the session. So please drop your questions into the Q&A box. And as a reminder that this session is being recorded and in approximately 2 weeks or so, it will be posted to farmers.gov taxes along with the slide deck. And when it is available, I will email all the registrants to let them know. So with those housekeeping taken care of, I will turn it over to JC.
Thank you, Janet. As mentioned, we're going to be covering the big, beautiful bill. And there's some things here that we want to definitely make you aware of. Our information in this project is working through with FSA. Our group is with ruraltax.org, which is a website hosted at Utah State University. And we develop material for tax education for farmers, ranchers, and timberland owners. So you'll notice here at the bottom of the screen, we've got a variety of information in terms of either fact sheets, webinars, sometimes both. And you can go to our website, it's ruraltax.org, and access those items. You can also, if you have questions concerning a specific tax issues, you'll notice on the bottom left-hand corner, there's a link, info@ruraltax.org. That is our email address. And your questions get forwarded to members of our committee. And we do our best to answer those on a timely manner. Sometimes we get a little complex question. It takes us a little more time to answer those, but we do respond back with our best guesstimate of what the answer is, and do a little bit of research to make sure we're correct. So with that, here's how we're working with USDA. This project is sponsored with support from USDA. We have an agreement, and what we find is we have put together materials. We remember any opinions, findings, or conclusions, recommendations are those of the authors and do not necessarily reflect the USDA or U.S. Department of Agriculture's point of view. We do our best. Again, we're trying to make sure that our answers to tax questions and our information on tax issues is correct. So with that, here's our disclaimer. So what you're looking at in this presentation, what is discussed, it should be considered formal, legal, or tax advice. None of that should be considered formal, legal, or tax advice. This is for education purposes only. The reason for that is everybody's specific tax situation is different. And when we start applying the rules, sometimes there's certain nuances or provisions that allow one person to take advantage of a situation that another cannot. So when you get to those legal and tax questions, be sure to talk to your advisor. And that's a professional attorney or tax professional that understands the subject matter and you feel comfortable with in terms of dealing and working with those. So everything we talk about today is in general terms. We're going to be looking at this very closely. We're going to try to do our best to give you the facts and circumstances to the answers. And any further guidance provided by the IRS or law changes will be forthcoming, and we will make note of those and provide those to you. Since this bill just passed and signed into law in July, there are some things that we're still a little bit curious about as how they will be applied. But we have a pretty good idea on the topics we'll be touching on today. So the areas where we're looking at, here's our program agenda. So the specific items that we'll be touching on are items that affect individual taxpayers, as well as items affecting the business side of our operation. So we're looking at farmers, ranchers, timberland owners in this discussion on the business side. So we're targeting it towards agriculture. So what's all taken place with the addition or acceptance, signing into law of the big, beautiful bill. Because what was going to happen, some provisions in the law was supposed to expire at the end of this year. And what the big, beautiful bill did was permanently extended some of those. Others are phased in, other items will be phased out. But here's what we know about the individual marginal tax rates. They were supposed to sunset at the end of 2025, go back to the rules that we saw prior to the passage of the Tax Cuts and Jobs Act. So if you look at the rates in 2017, they started out at 10%, went to 39.6. In 2026, they are been made permanent. So those individual marginal rates are there, 10%, 12%, 22. So we went from, we dropped off the 15, lowered it to 12, to 25, went to 22. So you can see that we've lowered rates for the most part across the board for all taxpayers. So again, this has been permanently extended for the future. And these rates are indexed for inflation. So as inflation goes up, those bracket ranges change as well. Another item that was changed was the standard deduction. Now, prior to the Tax Cuts and Jobs Act, those standard deductions were rather small. And currently, the way it reads, we've extended those larger amounts. So if you go back to the prior to the Tax Cuts and Jobs Act, a single individual was about $6,000 for a standard deduction. Now you can see now it's $15,750 for single, $31,500 for married filing joint. So those deductions amount, the standard deduction, definitely increased, made much larger, but there was a cost of doing this. You can probably remember the personal exemption, which was when it expired is about $4,000 per individual on your tax return. So a husband and wife each had $4,000. Well, that personal exemption has been wiped off the books, permanently repealed. We wrote note there says gone forever. Well, it could be reinstated, but it's going to take an act of Congress and a signing by the president to get that done. So the personal exemption right now for the future is gone. It's been permanently repealed. Now, the president originally and early on wanted to make Social Security not taxable. And that didn't come about. That didn't fly very well with Congress or anybody else. So what is currently in the books for 2025 through 2028 is a deduction for seniors. Those individuals 65 years of age or older. So each qualifying person, so if a husband is a 65 but the wife is not, we only get 6,000 for the one person. If both individuals are 65 and older, they'll get a $12,000 deduction. Now, there is a phase out. So if your modified adjusted gross income gets large enough, so 75,000 for a single filer, 150,000 for married filing joint, that amount, that 6,000 gets reduced. Now, that modified adjusted gross income, that's figured by your tax preparer and their tax software. So to kind of give you an idea that that's going to be at the time of filing when that is determined. But there's where the phase out does occur. And it is a 6% phase out if your modified adjusted gross income gets very large. Now, if you have children under the age of 18, the child tax credit has been around for a very long time, and it has been, they've referred to it in the bill as being enhanced. It's been increased. So for 2025, the amount now is $2,200 for each qualifying child. It was $2,000, so they increased it, they enhanced it by 10%. They've also added another provision with the child tax credit. It used to not be indexed for inflation. Now, from this point forward, it will be. It used to be a flat amount, didn't change unless Congress enacted and passed a newer number. Now, The 2,200 for 2025 will go up in 2026 by the amount of inflation. So that child tax credit is going to get improved. As they say, enhanced. It will increase this year and it will continue to increase in future years. Another area, and this is on the individual side because this flows from the Schedule C or the Schedule F. It's called the Qualified Business Income Deduction. So you get qualified business income. That is from the farm or another small business. And you're looking at the amount of qualified business income. 20% of that will flow to the 1040. And it's a reduction, a deduction. Well, the qualified business income deduction, the QBID, as it's referred to, has been made permanent. So it will not go away. It was intended to phase out. It's not. And it's also been improved or enhanced. And those items will start or kick in with the 2026 tax year. So for 2025, no change in this, but get ready for next year. In 2026, the minimum reduction will be $400 if at least $1,000 of active qualified business income exists. So even if your farm is losing money or not making a lot of money, as long as there's $1,000 of active business income, we get a $400 deduction. So we're going to get some improvement, we get some relief, and also this number or this amount gets indexed for inflation for future years as well. So not only has it been made permanent, it's been enhanced, it's been improved. We get the greater benefits from that. Now the casualty loss area. This one we used to be was a lot more lucrative than it is now. So casualty losses occur when we have fires, flood, etc. Theft losses. Well, the casualty loss deduction, when we passed the Tax Cuts and Jobs Act, it was limited. So if you look at this thing, permanent limitation of casualty and theft losses of personal use property occurred at that point in time. And here's why. In order for you to get a deduction here, it has to be larger than your amount of itemized deduction. When they raised the level of the itemized deduction, it had a big impact here. And by also raising that standard deduction, we wiped out a lot of what we called the 2% itemized deduction items, which a casualty loss was. So by the way things fell, an individual casualty loss at that point in time was lost unless the area that was impacted was or received a federal disaster declaration, either from the president or from FEMA. So it had to have a federal disaster declaration. If we had personal property that was lost, and in that case, we did get a deduction. Anything else that was lost, if it was not a federal disaster area declaration, that casualty loss didn't have an impact to us. Now the rules have changed. So we don't have to worry about only getting a federal disaster declaration. We can have a state disaster declaration as on the other side. So if your state is impacted, but the federal does not kick in, and the governor decides, yes, it is a disaster, that will allow you to take a deduction on the federal income tax return for a casualty loss. So it becomes deductible if the area is either federal disaster declared or state disaster declared. So this gives us an opportunity, a little bit of relief, and a definite improvement. Now the miscellaneous itemized deductions, that's what we were talking about a moment ago that I said were gone because of the fact that the Tax Cuts and Jobs Act raised the standard deduction, and in doing so to offset some of that lost revenue, there was a suspension of those miscellaneous itemized deductions. They are still going to be suspended. into the future with the big, beautiful bill being passed. There's some items like investment interest expense, gambling losses. They are still deductible, but they are subject to new limitations. So if you've got investment interest expense or gambling losses, you'll want to look at those, discuss those with your preparer. They're not as deductible as they used to be. There's a publication that I've marked here, publication 529, that goes through those miscellaneous deductions, gives additional information of what's impacted, what's not, and how to understand what is taking place with miscellaneous itemized deductions. The last thing that really applies to the non-business side of things, the estate and gift tax exemption. Now, this is the federal exemption for estate and gift taxes. So what we've done with the passage of the bill, we have a permanent retention of the higher exemptions that we received starting in 2018. So currently, the individual exemption for 2025 is $13,990,000 per individual. Double that for spouses if you decide to use what we call the unused exemption or the deceased spouse unused exemption carry forward. So double the 1399. To make that a little simpler, look at 2026. It goes to 15 million, and the exemption for husband and wife, if they elect to use that deceased spouse unused exemption provision, it goes to $30 million. So you'd have $30 million of assets. That's the fair market value of the date of death. If both husband and wife pass in the same year, both spouses pass the same year, they can pass $30 million of property to their heirs free of estate taxation. This was a provision that was supposed to have expired beginning in 2026. I started receiving calls about 2 years ago. Should we be worried about this? What should we be doing? Well, we resolved the issue of having to worry about it. We resolved the position of having to make a major change in our estate plans. Again, this has been made permanent of those higher exemption amounts, and the exemption amounts will continue to be indexed annually for inflation starting in 2027. So you'll notice in 2026 it's going to get jumped up. 2025 we're at 13.99 million. So with that, the next slide starts on the business side of things. I'm going to turn it over to Adam. Are there any questions that popped up? Looks like maybe we have a couple of them.
Yeah, JC, there was, and I kind of threw in some text for one, but I think it'd still be good to answer it. But why don't you start off with, what does the 6% phase out mean? And that's referencing the additional senior or temporary senior deduction. And it states, what does 6% phase out mean? Just reduce the deduction by 6% or each year between the 25 and 28?
Basically, the year that your modified adjusted gross income exceeds those numbers, that is the year you have to take that 6% deduction. It's calculated yearly, so that if for some reason your income goes down in 2027, and you don't kick into the modified adjusted gross being triggered, you get the 6% phase out does not take place. And it's 6% of that $6,000 deduction. So it's not a major impact, but it does have some value to it.
So, and one of the other questions that came up was, what is the permanent limitation on casualty and theft losses for personal use property? And I did grab some information. I can't remember if that one came from IRS or Christine's, but you may want to explain that as well. And then there's a couple of additional ones that just came in as well. And I think the other one is which losses qualify as a casualty loss. That kind of goes along with the permanent limitation. So
what you've got, if you're looking at the permanent limitation, what that means is as long as we have the higher standard deduction, and again, the reason for the loss of those itemized deductions was the provision passed many years ago on what we referred to as pay-go. For every deduction and that cost revenue, a loss of revenue on the tax side, we had to find something to increase revenue on the other side as well. So there's where the reason for those itemized deductions to be curtailed, repealed, etc. So as I understand the rules and reading the bill, until those itemized deductions brought back into place, and again, that would be an act of Congress to bring those back on, those items will be lost. Now, what constitutes a casualty loss? That's a loss by fire, flood, hurricanes, any weather-related event, as well as theft losses, etc. Now, the way the rules read on that, there's a set of parameters that you have to meet, and you're looking at, and this is what I really don't want to get too far in the weeds because it gets rather complex, but there's two figures you got to look at. What is the amount of the loss? And there is limitation, there's a limitation there, and then you have to look at all the items that were impacted in that loss. And there's a limitation there as well. So by having it, those two items, and it has to be a casualty loss or casual disaster area, is the only way you're going to get that information or that deduction. Now, what I would suggest doing, if you'll go to our website, that's the ruraltax.org website, there's actually a fact sheet that goes through all the items, business and non-business items, that would be included in a casualty loss. And it's about an 8-page fact sheet, and it breaks things down by business items. So if you're looking at a farm, it talks about the loss of fences, talks about the loss of machinery, talks about fire going through, weather-related losses. So it's a very good piece to go back and look at, and it gives a great information as to what those limitations are and how it impacts you. And if you have a casualty that goes through a fire, it tells you what information to gather before you go to your tax preparer. So visit our website, pull that down, read through it. It's a great set of information. Is there anything else, Adam?
I think, let's see here. I think that answered those questions. I think it's also important.
We'll answer them at the end of the session. So take it away, sir.
I appreciate it. I think it's also important to reiterate something that was made mention of earlier. All of the information that is provided is about as close to interpretation of that reconciliation package that was passed last month. Many individuals have been combing over the 800-page document. The tax portion is a single title and or chapter actually within a title of that particular bill. And we fully expect to be able to continue to receive additional information and guidance as the IRS itself is combing through the document, attempting to interpret it and to make sure that everything is on par. Okay? And so it is also not uncommon that after something like this occurs, that there may be potential requirements for additional legislation to fix sometimes some issues that may have been created by the tax bill that requires a law change, a piece of legislation to match what was actually intended. Okay? And so we do have an additional question that just popped up, JC, and I've got a feeling we may have some more of these. So I think that one let's hold until the end of the program, which shouldn't be too much longer. So as we move forward, starting off with the business tax items, we're going to start off with what many farmers and ranchers, and timberland owners as well, are always looking at, and that is our depreciation, because we know that many individuals are out there going, all right, what Internal Revenue Code items are out there that allows me to be able to reduce my taxable income. Well, one of those items that has always been termed as special depreciation, known as bonus depreciation, that has always been in this up and down type of piece, and it is something that often changes. It comes back, but it's going through a phase out. And it's the same thing again with regards to this bonus depreciation. Tax Cuts and Jobs Act brought it back to 100%, but over a 6, 7, 8 year period was slowly phasing it out. And so in the year 2025, bonus depreciation was only going to be valued at 40%. And then it was going to continue to decrease until it went away, until it sunset. But with the reconciliation package that was signed last month, it actually brings back bonus depreciation. It removes this unsettling that was taking place from one year to the next, and actually adds permanency to the bonus depreciation at 100%. Now, given the timing of the bill, etc., it is going to say, here are the rules with bonus depreciation for 2025. And it can get a little bit confusing. So if you made any purchases of qualified property that's eligible to be used with bonus depreciation prior to January 20th of this particular year, you're required to use the 40% value of that for bonus depreciation. However, after January 19th through December 31st, any property that has been acquired, that is qualifies, or that's known as qualified property, that is eligible for bonus depreciation, you will be able to choose whether or not you would like to use the 100% bonus or the 40% bonus. But starting after December 31st of this year, so what that effectively means is, especially if you are a calendar year taxpayer, that bonus depreciation, you will have to use 100% moving forward. And so this is obviously going to be something you're going to want to work with your tax professional towards the end of the year and begin to do some tax management planning and determine, is bonus depreciation actually the method that I want to use, or do I need to opt out of using that and revert to Section 179, etc. I did want to add in there, because this is something that also came about a few years back, maybe about 5, 6, 7 years ago now, that nothing has changed. We are still able to use bonus depreciation on trees and vines that have been planted and or grafted. Okay, and all of this bonus applies to business property as well as investment property, and can offset some other taxable income. Now we move on to Section 179, which has been around for quite a while. We have seen this continually increase for quite some time, at least as far back as I can remember now. Probably for 25, 30 years, we've gone through these ups and downs. But the reality is it's predominantly been the thresholds, limitations, etc., have been increasing. And so for 2025, the deduction that is allowed has been increased to $2.5 million from 1.25. So it has been effectively doubled. The phase-out threshold was also raised from $3.3 million to $4 million. And so what that means is we need to understand that phase-out is a dollar-for-dollar phase-out. So effectively, once you reach purchases of $6.5 million, you have phased out of being able to utilize Section 179. So beginning in 2026, as it has been in some other years, but starting in 2026, you will see the increased deduction limit be directly tied to an inflationary index calculation. Now, this is something else to remember, is this final bullet. You can only reduce business income down to zero. You cannot create a loss. You cannot create a loss by using Section 179. And so that is another limitation. And of course, in generalities, it's something that ought to be expected. 1099 miscellaneous and 1099 NEC. For some of you all that may not be familiar with 1099s, or many of us may only be familiar with 1099 miscellaneous and or NEC. NEC is a little bit newer, a newer 1099 compared to many of the others, but there really is a lot of 1099s, either as farmers, ranchers, timberland owners that we receive and or that we have to provide to others. And so many other 1099 informational returns have not seen any changes due to the reconciliation package. But these two are some that are predominantly used by farms, ranchers, and timberland owners that we may receive, but more likely we are the ones that must send these out. And so let's start off with these. The present rule has been, if I make a payment to somebody or a series of payments to somebody, whether that be an individual or a organization, i.e. business, and I have paid those individuals within the year $600 or more, not necessarily at one given time, but overall throughout the year, you are required to provide a 1099 miscellaneous and or 1099 NEC. And that rule continues on for the 2025 year. But beginning in 2026, the threshold to be required to report, i.e. send out a 1099 miscellaneous or 1099 NEC, whichever one is most appropriate given what you are providing that funding for, what you're paying for, will go up to $2,000 per year. So if I pay somebody $2,000 throughout the year, whether it happens in one check or multiple times throughout the year, you're going to be required to provide that 1099 informational return. Now, this is a real good thing, especially for many of those farmers that are quite reliant on a number of other individuals that are performing custom work, other contract labor, contracted work, use of veterinarians and others. Hopefully this will reduce starting in 26. Hopefully it will reduce some of the workload by reducing the number of forms that you may have to provide. So now we're going to talk about the gain on sale or exchange of farmland. This is not going to affect nearly as many farmers or ranchers, but I think it is something that everybody needs to be cognizant of, especially as it relates to those producers that are getting ready to transition into a new phase in life towards retirement, or we're doing some succession planning where there may be some sales taking place, or just an outright sale of my farmland. This might be able to help reduce our it's not going to reduce our overall tax burden that we may have to pay for capital gains on the sale of our farmland, but it's going to give us a little bit more leeway in how we might be able to more easily break up that payment. And so here's how this works. So if I, as a landowner, if I was either farming my land, okay, for 10 years, previously, for 10 years, okay, or I was leasing my property to a qualified farmer for 10 years previous to the sale, and the person I am selling it to is also a qualified farmer and agrees to a covenant that is going to require the property to be used only for farming activities for 10 years following the sale. Okay, so we are looking at 10 years prior to the sale and 10 years after the sale, i.e. prior to the sale it was used for farming purposes by a qualified farmer, and following the sale there has to be a covenant that guarantees that the property can only be used for farming activities by a qualified farmer. And if all of those work out to the affirmative, then I am going to be able to break up my cap gain tax that is going to be owed into 4 equal annual installments. Okay, and this could be relatively beneficial from a cash flow standpoint. Next, I work with a number of farms that have employees. I work with farms from those that are just starting off, where essentially it's a lot of free family labor, to farms that have literally 1,000 employees. And so this is something that I think we need to be cognizant of. And even for those beginning farmers or those small producers that hope to be able to grow and expand, you still need to remember you are a business and you may have employees and you may have to follow other laws that you may not have been associated or familiar with. And so let's talk about the Family Medical Leave Act business credit that came about not very long ago, but this act makes permanent what is known as the general business credit, and that credit can range between 12.5% and 25% of the amount of wages that are paid to a qualifying employee that is on family medical leave for up to 12 weeks. And so I kind of put down here, just because of the amount of time that we have today, we can't get into the weeds on a lot of this just because of how much time we have. And so the U.S. Department of Labor's Family and Medical Leave Information has a wonderful document that's out there that's relatively easy to go through and understand. And you can easily turn that into a quick checklist that helps you garner the information, and that's under IRC Section 45S. Okay, there are a number of very specific nuances for this with regards to who is eligible and the eligibility of the employee, the employer, etc. for this. And that IRC 45S it lays out really that 12, how do you get the 12, what's the difference between the 12.5 and how does it phase up to the 25 to be eligible for that? So I strongly encourage you to be able to utilize that. The other piece of this is the deduction for qualified overtime compensation. Now, an employer isn't necessarily eligible for this. However, many of the farms that we work with that do have employees, those owner operators, those managers, in many cases, even though you all may not be necessarily specialists within labor laws and or tax laws, I wanted to be able to provide you a little bit of information that you can take and maybe provide to your employees if you get asked these questions. To the run-up of this bill, we heard a lot of things about tips aren't going to be taxed, and we're not going to tax overtime compensation, and all these things. And as many of us know, there's a lot of politics that plays into a lot of the run-up for this, essentially as marketing. And so here are some of the rules around the deduction for qualified overtime compensation. And one of the words in here that you need to understand or be aware of that quickly tells you there's some significant limitations on eligibility, and that is that term qualified. So let's walk through this. Overtime on most farms and ranches is not required to be paid under the Fair Labor Standards Act. That is federal. Some of you that are on this webinar today may be in states that have a law that requires overtime to be paid on farms to farm workers, employees, and laborers. Okay? Just because the state requires it does not mean it was required by the Fair Labor Standards Act. All right? That is a very important distinction. And since the Fair Labor Standards Act does not require that overtime be paid to farm workers in general, all right, and this is really important in particular for our field workers and our general farm workers. Things change really quickly if you are a farm that may have a packing shed or another processing facility, and then not only are we not utilizing only our own crop that's coming in, but we may be processing or we may be packing out other product that is not owned by our farm, meaning it's coming from other farms. Then all of a sudden you may, in some very specific circumstances, now fall under the FLSA and may be required to pay overtime to those workers involved in those particular functions. Okay, so this is something you may need to talk to your tax professional to figure out where you fall in line with regards to that. And maybe, again, I sometimes will I'll use the term, put the word human back into HR. This might be one of those things to work with your tax professional to maybe develop a one-pager to help explain some of this to your workers. Okay. Now, the other note with regards to this is many individuals were under the assumption that, yes, even if I do qualify because I have qualified overtime compensation that's being provided to me, that there may be an assumption that 100% of that overtime is going to be tax-free. And again, it isn't. It is, if I receive double time, so if my normal wage is $12 an hour and I'm working overtime and that overtime is $24 an hour, first of all, the entire $24 is not eligible for this particular deduction. It is only the difference between your normal hourly wage and your overtime wage. So in this case, it's $12. Okay. Here are the other limitations. The deduction limitation is set at $12,500 for a single taxpayer and $25,000 for married filing joint. So what that means is if I'm above that, we may still be paying taxes on overtime. There's also a phase out that begins on your modified adjusted gross income when you reach $150,000 for a single payer and $300,000 for that married filing joint. Okay, so we've got the deduction limitation that's set on overtime at the $12,500 for single, $25,000 for married, with an overall phase out that begins at the $150,000 and $300,000 single versus married. All right, and with that, here are some resources that are already available to you. And so when you get on, and you can easily be able to find those, and many of these, again, are going to be found at our ruraltax.org, and ruraltax.org contains a lot of the information that is produced by our national committee, which is the National Farm Income Tax Extension Committee, which has that contract with the USDA that JC has told us about earlier on, and Utah State houses ruraltax.org. And so you can go to ruraltax.org and be able to find all of these documents there. And of course, here is our contact information with email addresses as well. So with that, JC, if you wouldn't mind hopping on, and we can go ahead and play, we can take our choice on who we want to replicate, whether it's Laurel and Hardy, Abbott and Costello, what have you, but there are a number of questions there for us to respond. So I'm going to let you take the first one, which is referencing those casualty losses. Would losses include the loss of livestock?
So here's one of livestock is a very unique situation. Here's the problem. Animals that we buy, whether they be breeding animals or stock that we're going to put on pasture and then sell after you've grown them for a while. Loss of those animals is not deductible. Here's what happens. The purchase price is allowed as to be deduction. We lose the animal. We've taken all the costs of raising that animal from the time we purchased it till it dies. We deduct those as operating expenses. Therefore, we've taken consideration of all the animal's value, and there is no additional loss that can be taken from that. Same thing with a raised animal. The cost of raising that animal from date of birth until it's sometime later on when it dies or is lost, all those expenses have been deducted as operating costs. Therefore, the value of that animal is zero. There is no loss that's allowed. So it's not great news, but there is no losses when you're looking at livestock that dies, burns up in a fire, killed by lightning, does not exist. The next one, ag buildings. Do they
JC,
qualify
I
for
think
deduction?
just real quick with regards to this and what you responded to, this is a very common question that we do receive a lot of is, well, I want to be able to write off because my animal died. But as JC has already noted, that we've already written off all the costs associated with the raising of that animal, either through depreciation and or through some other cash deduction on taxes. And we do, I think it's important that we also recognize there may be future revenue that is going to be lost, especially if it was a breeding animal, a milking animal. And unfortunately, it is what it is, but those are the tax rules with regards to that. So, JC, are you going to take the ag buildings? And I believe
Doesn't matter. If you want to grab it, go ahead. You're there.
I'm going to let you touch on that one because we had a lot of discussion on this a few weeks ago with regards to this. And it's something that we didn't touch on, and it's something we did not put into our document because there's still a lot of unknowns, and we are hoping that there's going to be some guidance coming out from this, right?
Deal is, most of our ag buildings qualify under separate rules. For example, in single-purpose livestock structures, they qualify, and as such, there's an immediate deduction for those. Now, the new manufacturing rule does not necessarily apply to ag structures. So consequently, you're going to have to look at this closely to see what your structure is being designed and built for. As the way I read the rules right now, the ag buildings, if they qualify as a qualified ag structure, 179, the bonus depreciation allows that immediate deduction. It has nothing to do with the new manufacturing rule. It's simply the rules that apply, again, in the 179 expensing election, as well as bonus depreciation.
Okay, and how will depreciation of qualified properties impact new farmers and USDA loans? It should be there should be no change or no impact with regards to those. So qualified properties and new farmers and USDA loans, that depreciation of machinery, of equipment, or other properties, depreciable assets, really shouldn't play a role in whether or not you are going to be eligible or ineligible for those USDA loans and or any other programs to our knowledge at this point in time, based on our present understanding. JC?
Right. Depreciation is a tax rule. And if you look at the USDA information for new farmers and USDA loans, that's really not a relevant issue, because normally when they start looking at loan applications and looking at your tax return, they understand the fact that they change or look at the depreciation and make their adjustments accordingly. So the way I read it, no impact. You're still going to qualify if the other things are allowed.
So, and this one is essentially same question. It should not matter. And the reality is, you said from ag production to livestock production. Livestock production is still agriculture. And so ag production continues to include, and JC, I'm going to have you, in case I forget something, please chime in. But that includes essentially the production of our row crops, floriculture, so greenhouse, nursery industry, poultry. Poultry is not considered livestock, but it is still considered ag production and agricultural activities. Apiculture, and even commercial fisheries, and the raising of seafood, non-wild caught. So Christmas trees, etc. I think I pretty much well covered it, that it all falls under the realm of ag production under Internal Revenue Code. What does not count as, and this is one thing that I know JC, myself, and many of our counterparts around the country usually see issues with, that people are unaware of, is, and I'm going to use a simple example here of somebody that decides to start raising grapes and then wants to produce those grapes into wine. And they don't have a separate entity, and all these other things. And so I'm never showing any revenue coming in from my grape production, and all my revenue is coming in from the sale of my wine. Processing those grapes into wine is not an agricultural or farming activity. The sale of wine is not considered farming activity or farm revenue. Okay? And so that would not be considered ag production. Turning strawberries into jam and selling my jam. All right? From an Internal Revenue Code piece. All right, whereas of the USDA, you still may be eligible for a number of different programs, activities, etc. under USDA, because there are differing definitions. Did I forget anything on that, JC? I don't think I did.
This next one on the farm conservation programs.
Yes.
The way I understand this and the way I've read this and interpreted, basically, if you're the landowner and you put your land into a conservation program and you're looking at that 10 years prior to that, it's still considered ag property, farm land. Consequently, it will qualify. If there's any holdover of that conservation program, the buyer has to be willing to accept that. And if so, then it would qualify for that 4-year. But both parties have to look at this very closely, and the buyer has to be willing to accept that blow over that conservation program if it's still going to hold into place. So, but the conservation program does not change the fact that it was agricultural property going in, and it will be agricultural property coming out.
And I think it's also important to note, and I work with a lot of farms and tax professionals as it relates to dealing with the conservation easement and conservation programs. And so, Ms. Linda, I don't know if you're talking about federal conservation program like CRP, or are we talking about conservation easements? I'm making the assumption on the conservation easement
It's
side
a
of it.
program, I would think, Adam, because the easement's a different ballgame.
And
And
so
that still applies. Same thing applies.
it still
If the
applies,
easement's there,
Yep.
you've got to look at the buyer being willing to accept that easement.
exactly. And so I just wanted to qualify that with regards to that. So based on what you're talking about, there may be some other questions with regards to it, but in general, it should apply. But dealing with the conservation easement side of things, in many cases, the qualified farmers may not end up having to pay just because of the way the conservation easement and the conservation easement credits that are available to qualified farmers. We typically don't see a very large amount of capital gain tax that may have to be owed. The next question we've got is, do all of these new laws, rules apply to farming cooperatives the same way, or are there distinctions between the two? So it is, many of these programs, if cooperatives were eligible for these programs prior to, they should still be eligible following. If there is going to be any limitations, I do not see any limitations with regards to cooperatives, business structures or otherwise, with very few exceptions to that, which have remained in place. And so I think this is going to be a facts and circumstances question on exactly which piece we're talking about, right? And so, for instance, C corporations are ineligible for Section 199A deduction. So I don't believe, and I don't remember seeing that was changed. JC?
Talking cooperatives here, not talking C corps.
Correct. And so, but
Co-ops or pass-throughs, you've got to really you don't want to convolute things. The way I
Yep.
read it, I don't think for the most part. But
I didn't see that.
I hate to hang my hat and say, yes, all the laws apply to cooperatives. I do not know for sure. I think we're going to have to look at that on a case-by-case situation. And as Adam pointed out, it's facts and circumstances. I don't think we can make a generalized statement any way, shape, or form concerning these farm cooperatives. So pretty much it's whatever you're dealing with, talk to your tax preparer, your tax information provider, etc., to get a better handle of just exactly what piece of that thing we're dealing with.
next, is there another way to say it that overtime compensation defaults to the federal rule despite any state rules when the activity is actually falling under another business entity on the back end, even if to the employee it is part of their regular shift? I'm going to say that you really need to work actually with a tax professional or even really an attorney that specializes in some of the labor rules with regards to that, or something that we probably need to discuss one-on-one outside of this. Because these particular laws, as it relates to labor and labor compensation, overtime compensation, who's eligible, who is not eligible, really does get down to the facts and circumstances surrounding every unique case, okay? And so we really don't want to kind of muddy the waters. But in general, the laws that are applying to dealing with the overtime is only looking at the federal piece. Okay? And you have to separate what is required by the feds. Typically, I'm not going to say even all the time, but typically, a federal law or a state law, the one that has to be followed, is going to be the more stringent of the two. So what this means is if you are in the state of New York, for instance, and I believe they have already started to institute the requirement for overtime, and I don't remember if it's this year, last year, next year, but I know New York has started that process. And so if you're in the state of New York and you are required to pay overtime above a certain number of hours, you're required to pay that overtime. However, that does not mean the employee is going to be eligible to be able to receive that particular benefit of not having to pay tax on that overtime compensation, because it still does not meet the definition of qualified overtime compensation under the Fair Labor Standards Act. Okay, so I don't know if that really answers your question, or if you were trying to go a little bit more in depth with regards to certain other pieces, such as the example of, if I have a farm, I have a packing house. If that packing house is only packing out, I'm not processing, it's essentially wash, grade, pack. And I may have overtime in there, but if it's all my stuff, then I may still be able to fall under the exemption under FLSA, and then that overtime those individuals may not be eligible for receiving that tax benefit. But if I am also, let's say, in a pay period, even if I take for 1 hour of that pay period somebody else's product that gets run through there, then all of a sudden you lose your federal exemptions, and now you're going to fall under those FLSA rules. I believe that is correct. But again, I would strongly encourage you to be able to work with an attorney that understands these ag labor compensatory rules, because it really gets into the weeds, and you really need to have all your ducks in a row with regards to that. Last one, IRS website.
All right, this is a fun one, Adam. So the IRS and Social Security, you're still going to have to follow those rules as they are written. What we're talking about in this presentation is the deduction that's allowed by this big, beautiful bill, which is entirely separate from the requirements from what is written here for IRS and stating for employees, as well as the Social Security Administration. The only thing that we've got to remember is, for the deduction for qualified overtime compensation, you got to follow the rules there, but it has no impact on what is going on from IRS and for Social Security on those employees. So you've got to have we're dealing with two pieces here, and they're treated entirely different or separately, and they're applied separately. One of them is for your tax return, one of them is for employment reasons. So keep those two separate, don't convolute them, which is very easy to do.
And there are no other questions with regards to that. And please, again, you need to remember this is based off of all of the information that we presently have. And even I've gone back even earlier today, I was going over seeing, has there been any other information that's come out via the IRS? Have there been any examples that lead us into what they're thinking with regards to some of these rules or new Internal Revenue Code based on that legislation? And even on the IRS's website, for the ones that we were discussing today anyhow, it was really taken almost directly from the actual section of the piece of legislation, title, chapter, and code. And so they're still going over it. And so I think it's important for all of us to try to stay up on this. Ask questions of your tax and legal professional if there's been any changes, anything that you need to know and understand. To be able to help with your record keeping and your accounting, to be able to track this. Watch for these particular webinars, and if there's updates to any of our publications on ruraltax.org, as well as any other pieces of information that may come out. So, and I do expect additional information to come out. When is really the question. It's not really if, it's really a matter of when. JC?
So the only thing really to keep in mind and remember is that, again, new information is going to be coming forward. Expect it. And if you, as you go through here and have additional questions, please email them to us. We'll be happy to respond to those and do our best to answer them accurately, as well as provide additional references, etc. So with that, thank you very much.
Thanks, guys, for being with us today. As always, we really appreciate your expertise and you sharing with us. For the audience, this has been recorded and it will be posted to farmers.gov/taxes in approximately 2 weeks. And when it is available, you will receive an email from me. And with that, everyone have a great afternoon.
Thanks, Janet. Thanks for attending.